Hello, and welcome to the launch of the Transition Finance Working Group's Global Public Funds and Transition Finance Report, which will examine the risks, barriers, and opportunities that global public funds can face with transition finance. My name is Emma McGarthy. I'm Head of Sustainability at the Official Monetary Financial Institutions Forum. And I'm going to take you through the key findings of our report. So the amount of capital investment which is required to transition to a sustainable economy is estimated to be as high as 5 trillion per year. This means that with their long-term horizons, vast capital and market influence, public pensions and sovereign funds are increasingly at the forefront of transition finance. The potential of these global public funds to drive the capital needed to hit net zero cannot be understated. And this is why we have embarked on this project. Against this backdrop, OMFIF Sustainable Policy Institute has published a new report in collaboration with Franklin Templeton, EY, and MSCI. The Global Public Funds and Transition Finance Report outlines the risks, barriers, and opportunities for global public funds as they begin to transition. This includes their approaches to transition finance so they can learn from each other. They can find areas of common concern, including the internal challenges of regulation and policy, and also the broader financial markets. Ultimately, this is to challenge and support stakeholders to work together and create a credible investment opportunity to meet the net zero goals of transitioning companies, industries, and also entire global economies. So the Transition Finance Working Group, as I've mentioned, includes Franklin Templeton, MSCI, and EY. The group, over a 3-month period, spoke with 12 global asset owners from Europe, North America, and the Asia Pacific, which represented more than 5 trillion of assets under management. The group conducted more than 20 hours of interviews and discussions. We had hundreds of pages of transcripts to go through, and this is what has formulated the key findings of the report and the report's content. We also ran a survey, which has also formed some of the statistics, charts, and other findings that have become a part of this report. So we firstly have examined the transition finance approaches of global public funds. We found that 67% of funds surveyed by OMFIF think that investment in transition industries will have more impact than in dark green projects or technology innovation. There are differing stakeholder directives and objectives within transition finance strategies. This has caused some confusion, discrepancy, and one of the things that we have found, and which we'll go to in our next section, is the need for convergence of criteria, clearer criteria, and clarity of definitions of what a transition finance approach should be. Funds need to speak with their stakeholders to understand where they can make the biggest impact on the transition. And as I've noted, increased portfolio emissions in the short to medium term is needed to create a long-term positive outcome for decarbonisation. Asset owners are taking a holistic approach, a holistic whole fund approach to allocating the capital towards transition. And transition finance is not yet an asset class in its own right. It is an investment target or a strategy, which, as I just noted, has taken a whole fund approach to allocating the capital. When we asked the funds that we spoke with what the biggest barrier, the biggest challenge was to effectively managing transition finance, one of the first things that pretty much all the funds that we spoke with said was policy and standards. In our survey, we found that 33% of funds think that the unclear policy environment is the biggest challenge to implementing their transition finance goals. 73% of funds say a transition taxonomy framework would support efforts to credibly allocate their assets. There was an overwhelming consensus that the International Sustainability Standards Board should be a common baseline. One of the biggest findings was that as much as standards were wanted, needed, and were used, the proliferation of standards has caused some confusion and, again, discrepancy in how transition finance is looked at and implemented. So the ISSB was held as being a gold standard and should be a common global baseline. Standards should take a bottom-up approach. And then for those in developed economies, they can add on materiality and other elements of standards, which, for example, the European Commission expects in their taxonomy frameworks. There is clearer policy is needed to enable capital flow and innovation towards transition-focused projects, technology, and investment. And this is a clear area where policymakers can make a big difference in helping the capital to move. And establishing credible transition plans is crucial to support the market's development. The second biggest barrier that we looked at, and the second chapter of the report, is investment opportunities. So in our survey, 58% of funds think that they can make the biggest impact in the energy sector. 62% of the funds that we surveyed believe there will be a global transition bond market with a similar scale to the green bond market within the next 5 years. So in terms of barriers to investment, scarcity of available assets, scarcity of credible transition plans, and currently poor return profiles is what is preventing increased investment in transition finance. Most face challenges in how and where to allocate transition investments and portfolios. And 27% of respondents felt that the second biggest barrier to implementing transition finance was the lack of commercially viable projects. A global carbon credit price and market are key to unlocking transition opportunities, but this does remain fractured. And again, this is where policymakers could have a real part to play in supporting a stronger carbon market and carbon price, which was felt as crucial to unlocking transition opportunities. Another thing that we found is that the building of teams across institutions with the right skill set still presents a big challenge. Finding experts in sustainability, but also in allocating investment strategies and portfolio management, upskilling those within the organizations is something which funds are beginning to do, but still remains a little bit of a challenge as they move towards increasing transition finance investments. And also taking things such as asset ownership strategies to support increased transition finance investment. When we were speaking with the funds, another important element of our conversations was blended finance and the need to increase investment into emerging markets to support transition finance. So 100% of funds believe that blended finance has an important role to help achieve sustainable development goals in emerging markets. Yet there is still a little bit of skepticism about how this can actually work and how this will function. So one of the things that we found was governments need to increase support with helping blended finance projects take place. This can be through risk mitigation tools and also putting the first subsidization of projects in place to support private sector taking a role in their investment. 67% cited insufficient scalability of projects as a major barrier to increase investment in emerging markets. And 50% say that they were unable to invest in blended finance because the returns on offer conflict with their fiduciary duty. This goes into the struggle that funds find with finding compliant investments in emerging markets. And this is with increased risk perception, which again, governments and also multilateral development banks play a role in supporting supporting risk being undertaken. One of the things that we did find was there is a lack of investment opportunities as opposed to a lack of tools. So the tools are there, it's just finding those investment opportunities to support the scaling of transition finance into emerging markets. So in conclusion, asset owners must share their experience to drive global initiatives, lead asset ownership practices, and use their collective as well as individual influence to help shape the financial market begin to transition. Some expect that up to 30% of their portfolios to be run through a transition finance lens by 2030, which is a really fantastic statistic. many working group members already report that they can make at least similar returns on brown to green transition investments as in the rest of their portfolios, which again shows the potential, the opportunities that transition finance projects and investments do play. There is also a belief that as the markets develop and mature, transition-related investments will begin to outperform, which again shows that the opportunities transition finance presents. So as much as there is still a long way to go, transition finance clearly has a huge opportunity in the market. A really fantastic thing of speaking with these funds is seeing the engagement that they have, the willingness that they have to begin to transition and to go on this journey, to work with their supply chains to begin this transition. So it really was a fantastic opportunity to get that insight into how they're looking at transition finance and what their transition finance strategies and opportunities are and look like. So with this in mind, I'd like to thank the funds that did engage with our working group. This includes APG, Australian Super, Cowsters, CalPERS, CDBQ, GIC, the Indonesian Investment Authority, the Korea Investment Corporation, Mubadala Investment Company, the Nigerian Sovereign Investment Authority, and the Norges Bank Investment Management, without whom we would not have had the wealth of content, the fantastic findings that we have. So a thank you to them for their engagement, for taking the time to speak with us in these interviews. I'd also like to thank the members of the Transition Finance Working Group, who we will now be coming to speak with to get their key takeaways. Thank you for listening. So I'd like to turn firstly to Am Simpson, who is Global Head of Sustainability at Franklin Templeton and is our working group chair. And Franklin has been the lead partner of the Transition Finance Working Group. Anne and I started talking about this at COP28. We realized there that we were seeing this need and this desire actually from the global public funds to start thinking about transition finance and to really start actively moving the capital that needs to be moved. But as much as they obviously want to do this, they want to progress and begin, we could still see then that there were a lot of barriers, and actually, a very beneficial thing to do would be to start putting together this working group, to start engaging with them, to understand what the challenges are. And this is then where the report has come from. So firstly, Anne, thank you so much for your support with the working group. Thank you for all your engagement with us. I think it's been a really excellent few months of discussions with these funds. So yeah, again, thank you very much. My first question to you is really, why are global public funds so important to the transition? And what are the ultimate goals of the working group? And why did we embark on this journey, essentially? Over to you.
No, thanks. And it's terrific to see this whole agenda, which was first opened up last year in COP in Dubai, with us all understanding the Paris Agreement sets the global goal for a net zero ambition on the world's energy supply. This is a big challenge, and we know finance is going to play a critical role. So that's why the transition matters. It matters to the global public policy agenda. We can't get there without private finance. We know that public coffers are not quite drained dry, but have a lot of competing expenditure. The governments need to be making. So the role of private finance is going to be really important. So that's one part of it. However, what's in it for private finance? Well, if we start looking at the global investors who are exploring transition finance, it's because it has an opportunity. We've always been talking about the energy transition as an issue of risk at company level, markets, maybe even a systemic risk, that is understood, but also risk brings opportunity. And that's what this project is about, is to look at not only the case for why transition finance matters, but how can we deploy capital and generate those repeatable, risk-adjusted returns, which is what public funds need. In other words, this is not an act of philanthropy. This is an act of fiduciary duty. This is where we need to deploy client capital in ways that generate those risk-adjusted returns. So it's the opportunity side. And then we all need to get very practical about how to get that done.
Yeah, no, absolutely. So what were your key takeaways from the research in the report and from the conversations that we have had? In particular, obviously, one of the things that we really looked at is the need to allocate and establish transition investments. So yeah, what were your your key takeaways?
Yeah, the first thing I'd like to thank OMFIF as our partner in all of this work. It's tremendously important. But also, I'd like to thank each of the capital allocators, the pension funds, the sovereign wealth funds, who gave so generously of their time. We typically had an hour and a half long one-on-one interview with each to really dig into this big question: what do we need to do, and how do we need to do it? And what came through on that, I think, is an understanding of the potential, an understanding of the opportunity. But the question is, how do we tackle the barriers? What about the policy agenda? There was tremendous interest in working out how to structure blended finance. Now that's something of real interest to me. I used to work at the World Bank. We know that partnership between the public and the private sector can really enable us to move further and faster into generating those risk-adjusted returns for investors, also providing the capital for the sustainable development that needs to be undertaken at market level. But blended finance is quite a new topic for many big investors. It's been around for a long time, but hasn't been a big driver of financial flows.
Yeah.
So what we're looking forward to next, having identified what the barriers are, what the level of interest is, to say, okay, now it's time to roll our sleeves up and start getting into a practical mode so we can begin designing the solutions. So this is a very exciting next stage for everyone.
Yeah, absolutely. I think actually an interesting thing with the blended finance piece is obviously we did talk about this with the funds that we spoke with, and we will talk with Barbara about this from EBRD a little bit later too. But there was obviously cynicism with blended finance. However, when we did a survey, there was 100% response was that blended finance is crucial, actually, if we are going to drive investment, especially into emerging markets. And so it's how we break through that cynicism. It's how we have the tools. It's then how we actually enact that and make it work, I think, is the impression that I get. So blended finance is still something that is going to hopefully work in the future.
It will, absolutely. I mean, the focus of blended finance is to see where the public sector essentially can lay off risk. And a lot of the places where transition finance is needed can't present the risk return profile that fiduciary investors need. Not only need, they want. And the money won't come unless we can provide that risk-adjusted return. What the public sector can do, maybe not deliver on the return side, that's up to the structure of the individual investment, the counterpart. That might be a company, a local authority, a government that's in the midst of that deal. What the public sector can do is lay off risk. In other words, it's going to address one of the major barriers to these financial flows is not just the perception, but also the reality of risk that needs to be addressed. So public money and public measures, it's not just about money. It can be tax credits, it can be insurance, it can be tariffs, it can be dispute resolution mechanisms that are going to give comfort to private sector investors that need to deploy, with that fiduciary sense of safety and soundness always to the fore. So I think it's a very exciting project, and I'm expecting great things to come from it.
Exactly. And thank you again so much. Thank you to Franklin Templeton and to you for your support with the working group, for your active and integral role to it, and especially with the conversations that we've been having with the funds. It's been a pleasure, and really looking forward to our launch, our in-person launch at COP29. So Anne, thank you
very much so. No, and thank you. It's partnership in action, which is what's going to really be our watchword for all this work.
Exactly. Thank you. So thank you so much, Anne. I'd like to now turn to the rest of our working group members who have been involved in this process and in the report research, speaking with all the funds that we've engaged with, and have also contributed articles and their own pieces into the report as well. So I'm joined today by Heather Taylor, who is Partner, Climate Change and Sustainability Services Practice at EY, Rumi Mahmood, who is Research Director at MSCI Sustainability Institute, Ulf Allenson, who is Chief Executive Officer and Founder at Ampersand Fixed Income Institute, Daniel Wild, who is Economic Advisor and Lead of Sovereign Wealth Funds at the Commonwealth Secretariat, and Barbara Rambusik, who is Global Director for Gender and Economic Inclusion at the European Bank for Reconstruction and Development. So thank you all for joining me today. Thank you again for your support and work through this process of speaking with the various funds, of engaging with the report that we have written. Heather, I'd like to go to you first of all. So obviously policy and standards were highlighted as one of the biggest, if not the biggest barrier to transitioning. What are your key takeaways from the conversations that we've had? What do you think is needed to drive stronger and more aligned standards and policy environments to support the transition? Over to you, and thank you again for yours and EY's support with this.
Thanks, Emma, and I've been thrilled to participate. It's been a great group and fascinating conversations. If you think about where we were even just a short year ago, the lack of standards was actually labeled the alphabet soup. We knew that there was confusion in the market. That confusion had created uncertainty and credibility issues. And we also know, and had it confirmed through our conversations, that the standards in this space, in sustainability, are evolving at a pace that is unprecedented. So we like to look at the progress. And in the last 18 months, we've seen standards issued by the International Sustainability Standards Board. CSRD has been implemented in the EU. And now, as recently as the end of October, really thrilled to see that the International Public Sector Accounting Board has now issued the public sector standards that align to ISSB. But what's really important in all of this is that capital markets and investors have been really driving the need for standards. So they're the ones that demanded the alignment. They needed information that was being used to assess risks, their investment risk, their portfolio risks. And the key to this is having language that's consistent. It's having language that allows us the ability to compare information. And also, it's really important, and I think it's linked to the alphabet soup that I mentioned, is that the market really needed integrity and credibility. And that is very doable when we all are singing from the same song sheet, that we're following the same standards, that we're speaking in the same language. And standards obviously are that platform to bring us all together so that we're looking at information in consistent ways and we're understanding it in consistent themes. So for me, in participating to this and listening to the investor community talk about the need to find projects, but it was the way that they were evaluating those investment opportunities in the projects. And it's just great to see that very quickly from a standard setting perspective, 18 months is very quick in standards, that the standards setters have responded in a very timely fashion. And knowing that the key to success for our planet is unlocking access to capital. And I really do feel that unlocking capital or the standards will have a key role in playing in unlocking that capital.
Yeah, absolutely. As you say, things have moved very rapidly in the last 18 months. And of course, yes, there has been a proliferation of standards. This is one of the things that the funds were saying, but also the fact that there has been this support and there is obviously a need for clarity, for convergence in standards. And one of the very stark findings was as you mentioned, the ISSB, the fact that this should be the gold standard and the common baseline. There was definitely a call for the ISSB to be that common language and that common framework. So this was a really excellent thing to see, and I think a very big takeaway from the conversations that we had. Thank you again, Heather. Rumi, Heather mentioned obviously the need to scale capital and investment. Obviously, standards are a big part of supporting that scale and that increased investment to support transition. Transition-labeled funds have become the fastest growing category of climate funds, which shows that, it has a massive potential in the market, and transition has a massive potential in the market. So why is it that transition-labeled funds have become the fastest growing category? And how can we ensure that transition funds investing aligns with fiduciary duty and risk-adjusted returns, which is one of the larger concerns, I would say, in terms of kind of going into these funds. And thank you again, Rumi, and to MSCI for your participation in this working group. Over to you.
Thanks, Emma. So the rapid growth of transition-labeled funds reflects a rising demand from institutional investors to support the global shift to a low-carbon economy. And yes, these are the fastest growing segment within climate funds, with over $50 billion in assets now, where over 70% of them actually launched in the last 4 years. And so driven by decarbonization trends and regulatory momentum, transition funds are seen by many institutional investors, especially in Europe, as long-term strategic investments, offering exposure to diverse sectors that are essential towards net zero goals. In the absence of a globally standardized definition of transition finance, these funds can adopt diverse approaches, allowing them to target various stages of decarbonization across sectors and regions. And this adaptability enables funds to support not only companies with strong decarbonization plans, but also those in high emissions industries that are beginning their transition journey. And such diversity can be highly appealing to institutional investors, as it allows them to tailor their investments to align with fiduciary duty, balancing climate impact with risk-adjusted returns. However, this flexibility also brings challenges. The broad use of transition label can lead to inconsistent definitions and approaches, creating difficulties for investors seeking to ensure that their capital is driving meaningful change. And for example, fund strategies can vary quite widely, from those focused on achieving Paris-aligned benchmark tracking to others supporting broader sustainability or social goals. And this diversity makes it essential for investors to conduct rigorous due diligence, assessing not only fund performance, but also the credibility of transition plans within portfolios. But ultimately, the gradation in transition funds reflects gradations in investor preference, and by applying robust frameworks and demanding credible, transparent transition plans from their portfolio companies, I think investors can meet risk-adjusted return expectations and contribute meaningfully to a sustainable future.
Thank you, Rumi. And yet again, a very positive finding, I think, from the conversations that we had is that those transition plans are being developed, are being integrated. There's still a long way to go with what that looks like, but it was a very positive finding that basically all the asset owners, the public funds that we spoke with, are expecting some kind of transition plan from their supply chain and from their network, which is a really, really brilliant thing to see. And I think, as you say, will bring a lot of confidence to the market long term. So thank you again. Ulf, a common thread among the funds was the view that more government policy is needed to enable the energy transition. Obviously, Heather and I have just discussed the need for policy and standards, but this goes further into also, supporting things like the energy transition. And funds have generally expressed little or no transition engagement through government bond portfolios so far. In particular, they're expressing more interest in corporate bonds. So why do you think this is? And obviously for you, fixed income is a big focus. So how does this then also fit in with that transition planning? Thank you again also for your support with the working group, and over to you.
Yeah, no, it's been an absolute pleasure to participate in this group, and a very interesting views and discussions with regards to that. It is interesting that we see the corporate bond portfolios being used quite a lot for transition. But as you exactly mentioned, government bonds form a very large part of almost all these funds portfolios. It's a natural allocation in terms of how we manage risk in global finance, and especially at the sort of large fund level. And one would think that, you know, if you are actually lending money to a government through purchasing their bonds, you would engage a lot on policy. But there's some quite natural reasons for why this is not maybe happening at the pace that one would expect. Well, number one, a large number of funds are actually in a governance way interlinked with the governments themselves. So if you're a sovereign wealth fund, you have a close relationship with your government, and then it is just from the governance perspective very hard to say that, you know, policy should change in one way or another. That's just not an area where you go into. Secondly, also maybe traditionally the liquid part of the portfolio in terms of sovereign bonds has been seen almost like a treasury function. It's not traditionally or historically where you have applied that much in terms of engagement. I should say probably in terms of you know, the past 2 decades or so, where central banks and other types of institutional investors have become very large part of the government bond markets. The marginal utility you can have as a sovereign wealth fund in terms of trying to engage on your government portfolio has been diminished. We should go back though to even like 30 years ago, the bond market as we saw in the US back then, and where the famous quote from Jim Carville around, "I want to be reborn as the bond market because I can intimidate anybody." That was 30 years ago. Maybe we will see a reinvention of that. There is, you know, transition work going on the policy side, but it's much more on the higher level rather than specific to the government bond structures. One interesting thing that also came out in these discussions, I think, was there's quite an openness in terms of investors of thinking about bond structures where you have linkages in terms of coupon levels, depending on whether there is a successful transition or not. And this makes a very clear sense from a portfolio allocation perspective, as we believe that, you know, most of these funds expressed a belief that, you know, their general risky assets will return better in a successful transition scenario. So if you can get a sort of negatively correlated hedge on the government bond side, that just makes a basic portfolio theory sense. So lots of interesting things coming out there. There's still also, I think, some discussions more to be had in terms of how do you look on the curve? How do you view short bond versus longer rated bonds? And I think almost none of the respondents in this survey had different perspectives in terms of the short and the long term when it comes to bonds, although they probably have it, or they had it, in terms of looking at the transition planning. So how that then translates into bond portfolios will be something that maybe can develop over the next couple of years.
Yeah, absolutely. And an interesting thing also was the confidence in the transition bond market growing and developing into something that will be quite strong and effective as well. So yeah, absolutely. I think a long way to go, but a lot of momentum and a lot of movement, which has been a very positive thing to see again in our discussions. Thank you again, Alf. Barbara, I'll come to you next. So we're talking about investment. We've been talking about the growth of the bond market. A big barrier we found to investment was the lack of available projects, and in particular, this is in emerging markets. So what we found with this is that actually there is risk in emerging markets, but it's more of a perception of risk rather as an actual risk that people are seeing. So obviously, we then began to talk about blended finance, which we know has been talked about for a very long time. Whilst there was skepticism from the funds that we spoke with about it, ultimately, it is seen as a crucial method of driving capital into emerging markets in particular. We really saw that with a survey that we conducted where 100% of respondents said blended finance is crucial to do this and to achieve this. So what role can NDBs, and obviously you're coming from EBRD, what role can NDBs play in supporting blended finance and in supporting money moving into emerging markets? Over to you. And thank you again for your participation in the working group as well.
Thanks a lot, Emma, and thank you very much for having me on the working group. And I really have to say it's been absolutely fascinating and so much food for thought across all the different interviews. So thanks a lot. So blended finance, I think, is recognized as an important vehicle, but I think sometimes it's maybe not fully understood. I think also what we heard is actually there's a need to build capacity, a need to build awareness across the different players within the market in terms of what a blended finance really can be and how it can be deployed in the most effective way. So if we look at the rationale for blended finance, it's of course to mobilize finance into parts of the globe, into parts of markets where finance isn't flowing for other reasons. And one of the reasons is very often risk, but as we heard, I think very clearly, it's very often the perception of risk rather than the actual risks. So this is about going into emerging markets, but also deploying new technologies, which I think is also very relevant if we talk about sustainability, sort of new green technologies and how they can really be financed and understood in terms of their role within the market, but also underserved regions and those that are maybe particularly affected by climate change, droughts, rising sea levels, all these sort of things. So blended finance can take away or can create a risk cushion in this context. The other, I think, important aspect of it is not just the sort of risk cushion, but it's also creating incentives. Blended finance can also, through incentive payments, actually attract investments into a certain region or into a certain market. And then thirdly, very importantly, is about capacity building. And we're using technical assistance to complement the blended finance and to build capacity of clients, of financial players in the system, of regulators, policymakers, really to create an ecosystem that actually incentivizes and attracts that finance. So I think MDBs play a critical role exactly in creating that ecosystem and in deploying this blended finance in the most effective way in order to mobilize ultimately private sector finance to go into those areas where it's not going at the moment. So MDBs individually have a big role to play, but I think it's even more powerful when MDBs come together. And this is what I've also mentioned during our discussions, this role of country-level platforms, where MDBs come together with other MDBs, but very importantly, with investors from the public, from the private sector, with local players, and importantly, local governments, regional governments, and other partners, in order to really look at what are the needs, what are the particular challenges for a country, for a region, what are the opportunities in terms of finance, what are the risks, what are the other capacity building, technical assistance requirements that are needed in order to come up with a package. And that, I think, is where blended finance can be at its most powerful. An example that I gave also during our conversations was North Macedonia, where EBRD is working with a range of other different MDBs, the government of North Macedonia, as well as the climate investment funds, in order to leverage investment and mobilize investments to retire coal assets and repower renewable energy, to diversify socioeconomic regeneration of the region, and also to invest in infrastructure. And then to support that with grants to build capacity on this sort of just element of the transition, to invest in people and skills, in a way also support this shift of local labor markets towards new green type of jobs, green types of skills. So there are many, many other examples, but I think it's how we deploy this blended finance as an instrument in order to get over perceived risks, mobilize finance, and ultimately build awareness within the market how this can be done in the best possible way.
Yeah, absolutely. And as you say, I think MDBs have a very crucial role in really supporting that blended finance and being effective and really supporting, as you said, emerging markets with that technical assistance and that kind of sharing of risk as well. So yeah, and again, thank you, Barbara, for joining us in this working group. It's been excellent. So Daniel, obviously a big part of obviously getting investment into emerging market and obviously scaling transition finance is also ensuring that this is a just transition and also ensuring that adaptation policies, investments and processes are in place. And it was evident in the conversations that we had that obviously whilst adaptation is viewed as very important, investment in adaptation has yet to produce financial return and therefore hasn't really been taken up. Obviously, this is a very important part of making sure that we are driving a just transition by ensuring that we're adapting to climate change. We're kind of at that point now. So how do we move this forward, and how do we drive adaptation? Over to you. And again, thank you very much for your support with the working group as well.
Well, thank you very much for the question, Emma. I'm glad that you asked me about adaptation, because I do think it's very important. We need to recognise not only is the world warming, the world has already warmed. We've already seen temperature rises of over 1 degree Celsius. And with carbon dioxide emissions at a record level, with the amount of momentum that's built into the fossil fuel industry, we're going to see further increases in temperature. And we know that that has a very significant effect on many countries. We know that it's increasing sea levels. We know that it's increasing the severity and frequency of tropical storms. We've seen things like Hurricane Maria, which caused economic damages equal to double Dominica's GDP. So we know this is a very important subject. We know that climate change adaptation spending is going to have to sharply increase from about 60 billion today to over 200 billion by 2030. And we know that pension funds and sovereign wealth funds are only contributing a small amount of that financing at the moment, and are only at the very beginning of thinking this issue through. And I think that's something that came out quite strongly from the conversations we had. They haven't yet done the detailed work that they've done on climate change mitigation, on climate change adaptation as of yet. So what are the specific things that pension funds and sovereign funds could do in this area? I think there are 5 things that could be considered to substantially increase investment. The first is for them to think through how they define, measure, and report adaptation investment. I think the second thing is for them to consider whether they could have specific targets, the amount that they're going to spend on adaptation. Some funds have done that for mitigation. Could that also be done for adaptation? I think the third thing is to think through, could they engage with some of the companies that they have equity stakes with their boards in order to ensure that those companies have properly thought through the potentially profitable opportunities in the climate change adaptation space. I think the fourth thing is, are there things that they could do, perhaps with the Bretton Woods institutions, perhaps with other organizations that offer concessional finance, things like blended finance, which could mean that they can get the profits and the risk-adjusted rates of return that they need from investing in adaptation to substantially scale up that investment. And then I think the last thing, where there's still a lot of work to be done, is recognizing that a significant amount of adaptation expenditure is going to have to be in small island developing states. They're really the countries which are going to be most severely affected by climate change. And by the nature of those states, they're small populations, they're small economies. The ticket sizes for investments are not always there at the level that's going to attract some of the bigger funds. So what can be done to pull different projects from those jurisdictions to put together investments with a bigger ticket size, which are then attractive to some of the pension funds and sovereign funds that we spoke to? So broadly speaking, I think those 5 things are what could be done to scale up adaptation financing.
Thank you, Daniel. And indeed, hopefully over the next couple of years, this is something that will be scaled and will grow, because it's becoming increasingly important, as we are unfortunately seeing. Thank you again to all our working group members for joining us on this journey of putting together the report. It's been a pleasure. Thank you so much to all the funds who have engaged with us, who gave us such open, insightful conversations, and which has really added to the wealth of content that we have and the findings from the report. This will continue, and the work that OMFIF is doing in the transition finance space will continue over the next couple of years. And we'll go into next year, where we will be exploring and tracking how global public funds, policymakers and investors can continue to implement transition finance. And we will delve deeper into these challenges. So please do read the report. We welcome your insights. We welcome your thoughts on it. We hope that you join us next year on this journey as we continue. And thank you again to everyone who has participated this year. And we hope you enjoy the report. Thank you again.
Thank you.